Moves. Traders have been busy over those days, but investors probably haven't felt much. If you add it all up, we've lost only about 60 points on the Dow Jones Industrial Average in these wild 5 trading sessions. MKM Partners' Katie Stockton says despite the recent slide in the markets, stocks are still poised to continue higher in the long term. But Peter Schiff of Euro Pacific Capital says choppy waters are ahead. Good to see you both. Katie, let me kick it off with you because you wrote in a note today that while the Standard & Poor's is in a corrective period, long-term uptrend is still intact. What's the basis for that? Why do you think it's still intact?
That's right. Well, we still, of course, have higher highs and higher lows in place, and our intermediate and long-term momentum models are still very much positive, even though there has been, of course, a loss of short-term momentum. And I'd really remind everybody that the S&P 500 recently reached a new all-time high, having exceeded resistance at its 2000 and 2007 highs. So this correction phase is actually very constructive, in my opinion, having been the first pullback following a pretty massive breakout, and it's done so without breaking any key support levels, in my opinion. So to me, ultimately, it should provide a buying opportunity.
All right, Peter, you're on the other side of that. You say bond yields have rebounded. How much of an impact is that going to have on stocks?
Well, I think investors are much too complacent here. I would agree. Long term, sure, the stock market's going to go up in dollars because the dollar is going to keep losing value. By the way, it hit a 4-month low today against the euro. That should be troubling for people. But, you know, I think people are underestimating just how much interest rates are going to go up, how fast rates are going to rise, and what the impact's going to be on the economy, on the housing market, on the stock market, on the banks, and on the government's ability to service its debts.
So how big of a sell-off would you expect then?
Well, unless the Fed, and I do expect the Fed to taper back the tapering talk. Remember, for years, they were talking about an exit strategy. And I always said that they were bluffing. They have no exit strategy. They still don't. Now they don't even talk about exit. They just talk about tapering. But ultimately, they're not going to do that. They're going to increase the size of their monthly QE. That's the only way to stop the bond market from imploding. And they will do that until they can't do it anymore.
Yeah. Katie, are investors going to see this pause in the market's run as an opportunity to get in? Are you still betting on the buy on the dip?
I'm still betting on it, and of course when we see a correction it never feels good, and that's what's happening, and it actually has affected some of the sentiment indicators that we track positively. So they're not at extreme levels, but it's pretty constructive to have seen what had been arguably an overly bullish market in terms of retail investor sentiment sort of retrace from that overly bullish level. So to me, this is an opportunity. What I'd like to see now is short-term momentum improve, so I think it's only a matter of days to maybe a couple of weeks before we do see that. Meanwhile, we have a little consolidation phase in place, which tends to be very frustrating for a lot of people. It represents a relative sort of balance between supply and demand.
I think we need a much bigger pullback, though, to get some fear back in the market and to take the Fed out of the game. You know, I said the Fed is just bluffing with all the talk of tapering because they know we have a phony recovery, and the minute they take away the monetary stimulus, the whole recovery illusion is going to fade. But they have to maintain this posture. But we do get a meaningful pullback in the bond market, which brings down the stock market, and the housing market starts to roll over again. The Fed is going to have to come clean and start talking about expanding its monthly QE, and that's what the market's going to need to go higher again. But again, it's an inflationary illusion. The underlying fundamentals beneath the economy and the stock market are getting worse, not better.
Yeah, but at the same time, what are the alternatives, Peter? I mean, if I'm going to take my money out of stocks, where am I going to get any kind of return anywhere?
To dollars or to the U.S. stock market?
To the U.S. stock market.
No, you're right. You can't be in the bank. You're going to lose. Inflation is going to wipe you out. You can't buy the long end of the curve in the bond market. So, look, you've got to look around the world and figure out where you're going to store your wealth. I think there are better places than the U.S. stock market. I'd rather be in the U.S. stock market than the U.S. bond market, even though I think we got a bigger correction coming. But I'd rather be invested globally. I'd rather look at foreign stocks. I still like gold and silver, even though the sentiment is so negative now. In fact, that's one of the reasons that I like it even more. And you can look at some of these gold stocks. They've actually collapsed in price. So if you want to have some real upside, you can look at those markets. But you have to understand that we still have a real crash ahead of us in the United States that we have to deal with. 2008 wasn't the crash. The real crisis is still coming because we didn't solve any of the problems. The government, the Federal Reserve, made all those problems worse. And so we have to deal with this. And it's going to be better, I think, if your assets are as far away from the U.S. as possible when that